Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. If you have questions or topics you wish to discuss, please chat those over now. All right, this is your chance to ask questions. Please chat over questions or topics you'd like to discuss, whether on this topic or either unrelated topics. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So welcome to another daily Q&A session with my Solo 401k Financial. Today's topic is final days of 2025 planning, same day solo 401k setup. Our goal is to help you stop overpaying taxes and start building real retirement wealth. Again, this is your chance to get answers. Please use the chat now to ask questions on today's topic or anything else. Please chat them over now so that we can be sure to get to them all. So we'll start out with the first question that was chatted up. Then we'll go through some slides, and then we'll keep going through questions as if you would like to go through them. Please just chat them over. Couple clarifications. If I have a plan in place, a solo 401k, when I start using you as a plan provider, it's just a restatement, correct? If so, is there any advantage to signing up for the restatement by December 31st, or should I just finish the process in the beginning of the new year? So first of all, your understanding is correct. So it's very common that clients will start out with the basic plan somewhere else and then want to come over to our plan to take advantage of the service and features of our plan, such as the ability to make mega backdoor Roth solo 401k contributions, the ability to claim $1,500 in solo 401k tax credits, the ongoing compliance support, such as the Form 5500EZ. For example, with the 5500EZ, that needs to be filed if the value of the plan exceeds $250,000. And so if that is not filed, the late fees are $250 per day, which can of course accumulate to a very high amount very quickly. So as far as the process, when someone has a basic plan and then wants to upgrade to our plan to take advantage of the service and features of our plan, it is a restatement. So it's a document update. So the existing basic plan documents, those vanilla documents that don't allow for those advanced service or features, are replaced with our IRS approved plan documents. Now, as part of that restatement process, new accounts do need to be established for the restated plan because those existing accounts are governed by those basic vanilla solo 401k documents that don't support the advanced features. So new accounts will need to be established. Now, as far as why someone might want to restate the plan documents before or on or before December 31st, 2025, well, it would be to allow that solopreneur to start claiming those $1,500 in solo 401k tax credits. So our plan will make the self-employed person, the solopreneur, eligible to claim tax credits of $500 per year for 3 consecutive years. So if they wait to restate the plan until 2026, then they wouldn't be able to start claiming those tax credits until they file their 2026 tax return, and then again for 2 more years. Whereas if they restate here in 2025, then they'd be able to start claiming those tax credits when they file their 2025 tax return. And keep in mind that we prepare those restated solo 401k plan documents within the same business day when they sign up. So there's still time to get it done. They don't need to open up the new accounts by the end of the year. They don't need to transfer the cash and assets over from the pre-existing accounts to the new accounts by the end of the year. All they would need to do is restate the plan to now include the auto enrollment feature that's needed to make the self-employed business eligible to claim those tax credits. Now, keep in mind that auto enrollment feature will establish a default 3% contribution percentage, but the solopreneur, as the solo 401k participant, has the right to opt out of the default 3% contribution percentage and contribute in whichever schedule or amount they prefer, obviously subject to the limits and the deadlines. That's a great question. Thank you so much for bringing it, Evan. Now let's go to the next question from RB. I'm a sole proprietor without any employees. My wife did some work for my business and received $10,500 compensation as an independent contractor. My business will issue her a 1099. Can she be part of my business 401k plan, or will she need a separate solo 401k plan? She does not have any other income. Is there a minimum income limit she needs to have to be eligible? So when you have two spouses that are both working together in the same self-employed business, both reporting their own earned self-employment income, and there are no non-owner, non-spouse full-time W-2 employees working for any business owned by either spouse, both spouses can work in the same or I should say, can participate in the same solo 401k plan that's sponsored by that same business that they work together in. So if each spouse, for example, is filing a Schedule C, no employees other than the two of them working for any business owned by either of them, then they both can participate in the same solo 401k plan. Now, the other spouse would need to be added as a trustee to enable that second spouse to be able to participate in the plan. And then that spouse would be able to open up an account under the name and EIN number of that solo 401k to hold that second spouse's retirement money. And if they have multiple types of funds, like say they're making pre-tax as well as Roth contributions, even mega backdoor Roth contributions, there'd be separate accounts, but it would still just be considered to be one plan. That second spouse is going to be able to make contributions based on their situation, based on their age, based on their earned self-employment income, whether they participate in another plan like a day job plan. I know you mentioned that wouldn't apply here, but just to keep that in mind. As far as whether there is a minimum income limit that she would need to have to be eligible, no, there is not. There's no minimum income limit generally for a solopreneur, for a self-employed person to be able to open up and participate in a solo 401k. Now, of course, if they don't make a relatively high amount of earned self-employment income, they're not going to be able to contribute relatively much to the solo 401k because your ability to contribute is a function of your earned self-employment income, but it wouldn't stop them from being able to set up a solo 401k. In other words, a solo 401k is not just for solopreneurs that make a lot of money, even though someone that makes a relatively small amount of money. If they're reporting that earned self-employment income and there's no non-owner, non-spouse employees working for any business that they own, then that person would be eligible to set up and participate in the solo 401k. Great question from RB. Next question is from Sherry. And thanks for checking out the AI, solo401k.ai. I need to understand my contribution limits. If I pay myself $7,000, can I contribute $7,000 in the solo 401k and in the traditional IRA? Or would my income have to be inclusive of both amounts? Like I would have to have a salary myself at $14,000 to make a $7,000 contribution to both. So this is a great set of questions here, Sherry. Thank you so much for bringing it. So first of all, there's a few concepts to understand. One is you need to be eligible to be able to participate in a solo 401k. So you got to have earned self-employment income with no non-owner, non-spouse employees working for any business owned by that person or a spouse, if any. Another concept is that In order for someone that participates in a 401k to make contributions, they have to have earned income to justify those contributions. So the whole concept of a 401k is for someone who works to be able to save for retirement. So in the context of a self-employed person and in the context of a solopreneur, in order to make contributions to the solo 401k, they have to have earned self-employment income. So you can't save more than your earned self-employment income. Now, when you run those solo 401k contribution limits, making contributions to an IRA does not reduce your ability to contribute to the solo 401k. So it's not like the solo 401k contribution limit, for example, for 2025, for someone that's under 50 years of age, is $70,000. So if they contributed $7,000 to an IRA, if they got the earned self-employment income, they could make another $70,000 contribution to the solo 401k. Now, with that in mind, from an IRA perspective, if you make too much money, you may not be able to make what's called a deductible IRA contribution, a pre-tax IRA contribution. So there are rules that provide that for someone who's participating in an employer plan, which is what a solo 401k is, it's a 401k plan. If their income is above a certain amount, you'd have to check with your tax advisor so that they can look at your overall income. But if it's above a certain amount, you cannot make a deductible IRA contribution if you're also participating in a 401k. But as far as your specific question, just like you have to have earned self-employment income to justify a contribution to a solo 401k, you have to have earned income to justify a contribution to an IRA. Now, the definition of income is broader with regards to an IRA. So, for example, if someone has a W-2 job at a corporation, they cannot use those W-2 wages to justify contribution to the solo 401k, but they could use those W-2 wages to justify contributions to an IRA. So you've got other types of income that you could consider to justify that IRA contribution. But if this person has no other income, their only income is their self-employment income, and they're contributing it all to the solo 401k, they couldn't use that same income to also justify a contribution to an IRA. Hopefully that helps. Thanks so much for the good question, Sherry. Another question from Sherry. I want to understand how to use after-tax 401k bucket. If I payroll myself $7,000, can I make $7,000 employee contribution, $1,875 employer contribution, and then add $5,000 into the after-tax 401k? No, you cannot, because the total amount of contributions to the solo 401k cannot exceed the lesser of your W-2 wages or the overall limit. Here, your wages are definitely less than the overall limit. So if the individual contributed 100% of their wages as an employee contribution to the solo 401k, they're not going to be able to make any more contributions to the solo 401k because they already used up all their income. Back to ER. My husband is currently part of my solo 401k plan. Like RB, he has no income, but I pay him enough to contribute $23,500. I currently have my accounts with the census, and we are both charged for this. If I transfer to you, is the fee to cover both of us? So yes, our fee is per plan. So if you have two spouses that are both participating in the solo 401k plan, it's just one $650 fee. That one $650 fee covers both spouses. So we charge $525 establishment fee plus the first $125 annual fee, which amounts to $650. Starting 12 months later, we charge our $125 annual fee that covers the second year, and that covers both of you. Keep in mind, upgrading a basic solo 401k plan at a census to our solo 401k plan is a common occurrence, and that will qualify the self-employed business to be able to claim $1,500 in solo 401k tax credits, because those tax credits are not just available to new plans, they're also available to existing plans that are upgraded to our plan to include the auto enrollment feature that needs to be included to make the self-employed business eligible to claim the credits. Back to Evan. If I've already maxed out the individual contribution for 2025, 23,500, and I have matching 18,000 in my existing solo 401k. Keep in mind, matching contributions do not apply to a solo 401k. Instead, you can make employer profit sharing contributions, but matching contributions apply to a full-time employer plan. So let's assume you're referring to employer contributions. So if you've already maxed out the employee, you've made employer contributions, when I restate the plan with my solo 401k, will I still be able to do a mega backdoor? Yes, assuming that you have additional capacity that you haven't contributed, which you would based on the scenario presented, and assuming that you got the earned self-employment income for 2025 to justify that additional voluntary after-tax contribution. And you would have until your business tax return deadline, including any timely filed extension, to make that voluntary after-tax contribution. Also, am I correct in thinking that a Roth IRA contribution of $7,000 is separate and still possible even without maxing the 70,000? Yes, you are. So making a solo 401k contribution does not reduce your ability to make a Roth IRA contribution. And likewise, vice versa. Making a Roth IRA contribution does not reduce one's ability to make a solo 401k, make a backdoor Roth contribution. Great question. So now let's go through some slides that we wanted to share. So as far as the December 31st deadline, so why it matters is that establishing the plan documents by December 31st, which we create those plan documents within the same day. That's what we talk about, same day setup. That will preserve the ability of the solopreneur, of the self-employed person, to open accounts, fund accounts in 2026, and make those 2025 solo 401k contributions all the way up until their business tax return deadline, including any timely filed extension next year. So it keeps all your solo 401k options open, giving you the most time to make those solo 401k contributions. Also, by establishing the plan in 2025, now the solopreneur can start to claim those $1,500 in tax credits. That's $500 per year for 3 consecutive years. So starting with the 2025 tax return. Now, who's eligible for a solo 401k? Well, it's what they refer to as an owner-only plan. So full-time employer plans, those, for example, that are offered to employees that work in corporate America, those are for big employers. But even someone who's self-employed can set up their own 401k. And it's referred to in the marketplace as a solo 401k. If you look at the statute, if you look at the IRS code, it's referred to as a one participant plan. Now, there are exceptions to that one participant requirement. For example, a spouse who's working in the business and reporting the spouse's own earned self-employment income can participate. Another owner of the business, who's at least a 3% or more owner, also reporting their own earned self-employment income, can participate. It's still considered to be an owner-only plan. Now, there are 2 elements to be eligible. There's 2 criteria. One, you need to report earned self-employment income. And there's different ways to report earned self-employment income. For example, if your business is taxed as a sole proprietorship, could be a single member LLC taxed as a sole proprietorship. Earned self-employment income is income reported on Schedule C of your 1040. Whereas if your business is taxed as an S Corp or a C Corp, earned self-employment income is income reported on a W-2 that you receive from the S Corp or the C Corp. Lastly, if your business is taxed as a partnership, earned self-employment income is income reported on line 14 of the K1 that you receive from the partnership. Now, the other criteria, the other element in terms of being eligible for a solo 401k, it goes back to that owner only requirement. That means there can be no non-owner, non-spouse, full-time W-2 employees. So a full-time W-2 employee would be someone who's 21 years or older, working at least 1,000 hours a year with a year of service, or 500 hours a year for 2 consecutive years. So that means that you could hire contractors, because those are not W-2 employees. You could have W-2 employees, but as long as they're not working on a full-time basis, and still be able to maintain that solo 401k. As we talked about during the initial questions and the initial Q&A session, there's no minimum amount of earned self-employment income that someone needs to be eligible to set up a solo 401k. It's also noteworthy that you can have a solo 401k even if you participate in your W-2 employer sponsor plan. In other words, even if you have a day job, even if you participate in your day job 401k, if you've got that separate side self-employment income, you could still set up a solo 401k. Now, as far as the December 31st deadline, all that's needed is to establish the plan documents. You don't need to open up the holding accounts. You don't need to determine how much you're going to contribute. You don't need to make those 2025 contributions. So you can open now and fund later. So the critical deadline is December 31st, because if you look at the IRS guidance in IRS publication 560, which is the landmark guidance for solo 401ks, for self-employed retirement plans, they make clear that as long as the plan is established by the end of the year, that preserves your ability to make all types of contributions, whether employee, employer, or voluntary after tax, by your business tax return deadline, including any timely filed extension. So that means you focus on the documents first, and then the accounts, the holding accounts later. Now, with my solo 401k financial, we make it easy to meet the deadline because we prepare the documents within the same business day. When someone signs up, then you can take your time to open up the holding accounts. We don't hold your money. We don't provide investment advice. We don't have access to your accounts, but we're still very hands-on in helping you open up accounts at the bank or brokerage of choice. And we've helped thousands and thousands of customers open up accounts at places like Fidelity, Schwab, credit unions, local banks, etc. So what you need to do by December 31st is just sign up, because we'll prepare the documents within the same business day. It's just 10 simple questions on our online application, straightforward information, such as your name, the name of your business, your address, what you want to name the plan. We recommend 2 words in the word trust for a total of 3 words. Once that information is submitted via the online application and payment is made, we will prepare the plan documents within the same business day. That establishes the plan. You can take your time to return the completed and signed documents. Take your time to let us know where you want to open up the accounts. That could happen in 2026 because now you've met the deadline. So now you have time to determine how much you're going to contribute and make those contributions, open up those holding accounts by your business tax return deadline, including any timely filed extension in 2026. And again, this is clear per IRS publication 560. And it makes sense from a policy perspective that the deadline to make contributions for a self-employed person won't be the end of the year, because many self-employed individuals don't know how much they might have made until after the end of the year. They might have a seasonal business where they're working all the way up to the end of the year, and so they don't know exactly how much they made until after the end of the year. And as we discussed, your ability to contribute to the plan is based off of your earned income. So you first need to determine exactly how much you have made. Then you can determine how much you're eligible to contribute, and then how much you want to contribute. And keep in mind, we're very hands-on and educating customers on those contribution limits and how it applies to their scenario. So it's just a quick 1, 2, 3 process. You can sign up at mysolo401k.net. Just click on open account, then click on get started under solo 401k. Again, just 10 simple questions. It just takes a minute. Once you submit the application and payment is made, We prepare the documents within the same day. An email goes out with a link to our secure portal where you can download the documents that were drafted specifically for your business. And then when you're ready in 2026 to open up accounts, you can return the completed and signed pages and submit the next steps questionnaire. So in that same initial email that will go out within the same business day when you sign up, there'll be number one, a link to our secure portal to return back the completed and signed pages, as well as another link to our next steps questionnaire where customers or their advisors will let us know where they want to open up the accounts at. And again, we're neutral as far as where the accounts are at. So we don't force our clients to go to a specific institution. We don't hold your money, but we're still very hands-on in helping you open up accounts, whether it's at Fidelity or Schwab, or if you're working with an advisor, it could be Altruist or Fidelity Institutional or Schwab Institutional, etc. Okay, so we do want to take a moment to ask you to please like this video. Liking this video is going to help other solopreneurs, other advisors like you find this information, which might be very valuable to them if they're trying to meet the December 31st deadline. So that'd be very much appreciated, whether you're on LinkedIn or YouTube or X or Instagram. If you please like this video, it would be greatly appreciated. Also, we invite you to subscribe. We do go live every day. If you subscribe, you get notifications of when we go live, so you can come and ask questions or hear what other individuals are asking or the content that we want to share. So we invite you to subscribe, again, whether you're on LinkedIn or X or Instagram, YouTube. All right, so now let's go through some more questions. Let's see here. ER, how much assistance do you offer once established with you? We would be switching from a financial advisor to manage my current solo 401k plan to your plan. We would need help with backdoor Roth, potentially a mega backdoor. So we're very hands-on in helping clients through the mechanical process via email, via phone. We have these daily webinars. So we have a ton of information as well. And we've helped thousands and thousands of customers with these exact type of scenarios. For example, the mega backdoor Roth is one of the most popular reasons that clients sign up with us. Back to Sherry. Could I purchase shares in the business from my personal account and then sell it to my solo 401k after I make a new employee contribution and can afford to buy it from my solo 401k? Is that self-dealing? Yes, that is self-dealing. So you cannot sell or otherwise transfer a personal asset to your solo 401k. Moreover, sometimes individuals will have an opportunity to invest in a company, but they might have that opportunity based on work that they've done for that company, right? If you're working for a company and your employer offers you a chance to invest, say, in the stock of the business, that is really a benefit that you receive based on being an employee. So that is a personal asset, just the right to invest. That opportunity is a personal asset. So it's not possible to transfer that asset to your solo 401k and use your solo 401k funds to buy the stock either. We don't recommend any specific banks per se. We've helped customers open up accounts at hundreds of different banks and credit unions. Now, there are certain online banks that are very familiar and happy to open up solo 401k plans. And of course, we know the leadership at those different institutions. And so we can definitely facilitate opening up accounts at those institutions. It's also noteworthy that in terms of meeting the December 31st deadline, there's no requirement to open up the accounts by the end of the year. But overall, we do track where customers are opening up accounts. We don't have access to the accounts, so we don't always know where they're opening up the accounts, but we do have a database, internal database of different banks across the country that customers have opened up accounts at. So that's another option. We're aware of certain banks that have just not been willing to open up accounts for our customers generally, or really for any solo 401k customers generally. For example, Chase is in that category. But there are other national banks where customers have opened up accounts and they do so regularly, like Wells Fargo. So it just varies. Hopefully that helps though. Is a separate EIN required for a restated plan, or does the S Corp EIN work? So first of all, there's no requirement to obtain an EIN for the plan by the end of the year. Yes, there's a requirement to obtain an EIN, and yes, it needs to be different than the EIN that the individual has for their business, like their S Corp, but the EIN is needed as part of the account opening process, which again can happen by the business tax return deadline, including any timely filed extension. So, for example, if someone is restating the plan, it's a basic plan at Fidelity or Schwab. Fidelity and Schwab, they don't require their customers, they don't direct their customers to obtain an EIN number for the solo 401k, even though that's the IRS expectation. So with that population of customers, when they restate the R plan documents, they don't have an EIN for their solo 401k, which is typical, and it's fine. As part of the restatement process, we will obtain an EIN number for the solo 401k. New accounts will need to be opened regardless for the restated plan. And so as part of that account opening process, we will obtain an EIN number for the restated plan, and then that EIN number will be used to open up the accounts for the restated plan, and then the cash and assets transferred from the pre-existing account to the new account. Thanks for sharing your feedback, Sherry. Do you have advice on when to contribute to backdoor Roth? Can we do ours in 2025, or should we wait until the first week of January for 2025? So if we're talking about the mega backdoor Roth solo 401k, that's really a two-step process where you first make a voluntary after-tax solo 401k contribution, needs to go into a separate voluntary after-tax solo 401k account so that you can take advantage of the higher voluntary after-tax solo 401k contribution limits. And then it gets moved from the voluntary after-tax solo 401k account to either a Roth solo 401k or a Roth IRA. And the reason that you do that is that it can start to grow on a tax deferred, potentially tax free basis, because this will be just like any other funds in a Roth account. So it's that two-step process. For purposes of the 2025 voluntary after-tax contribution deadline, you have until your business tax return deadline, including any timely filed extension in 2026, to make those voluntary after-tax contributions. So there's no need to make it by the end of the year. It's certainly acceptable to make it in 2026 for 2025, as long as it's made by that business tax return deadline, including any timely filed extension. And then there's no deadline to move the money from the after-tax account to the Roth solo 401k or Roth IRA. Now, most will choose to move it shortly after they deposit the money so they can start to accumulate those potentially tax-free gains. It's also noteworthy that the first step, when you make that contribution, the voluntary after-tax contribution is not reported on the personal tax return or the business tax return. It's not even reported on the W-2 in the case of a business like an S Corp, where the individual receives a W-2 from their S Corp. But the second step, when you move the money from the after-tax account to the Roth account, either a Roth solo 401k or a Roth IRA, that does need to be reported. It needs to be reported by the plan on a Form 1099-R. Now, what's great is that we handle that 1099-R for our customers, and we don't charge an additional fee for that. They just simply need to let us know when they move the money from the after-tax account to the Roth account, because again, we don't have access to the accounts, so they can give us the information we need to prepare the 1099-R. And then we just simply add their plan to the queue to have it prepared, again, for no additional charge. Another question from Evan. Thank you for bringing it. Can you explain what auto enroll feature is that makes the plan eligible for the tax benefit? Absolutely. And that's, again, one of the reasons. So taking a look at these slides, right? Why set up by the end of the year? Well, number one, lock in your ability to make all types of solo 401k contributions for 2025, whether employee, employer, or voluntary after tax. So lock in the ability to make the most types of contributions and have the most time to do it in, because now you'll be able to make those contributions by the business tax return deadline, including any timely filed extension in 2026. Another top reason would be to be able to start claiming $1,500 in tax credits. So let's talk about those tax credits. So Congress perceived a retirement savings crisis, and via the Secure Act, encouraged businesses to maintain, establish, enhance 401k plans so that the taxpayers could start to save more money in their 401k plans to address the perceived retirement savings crisis. And the way that Congress is trying to encourage participation in a 401k is through tax credits. So there are two tax credits that were authorized by Congress in the Secure Act. One is not available to a solo 401k. That is a startup cost credit. But there's another tax credit that was authorized under the Secure Act, which is the auto enrollment credit. So this credit is available to either a new plan or even an existing plan that's upgraded to include the auto enrollment feature. So that means that the plan documents need to have that feature elected. There needs to be certain notices provided to the solo 401k participants. So with my solo 401k financial, we were the first provider to offer the tax credits or plans that were eligible for the tax credits. We worked with the IRS legal staff and other industry stakeholders for almost a year before we rolled it out at the end of 2023. And now you see others in the marketplace, other providers that are starting to roll out their plans that are eligible for the tax credits, which is great because it gets the word out to solopreneurs, because this can be a powerful way to enable and facilitate a solopreneur to be able to establish a solo 401k and start to maybe catch up on their retirement savings. So again, the key is that the plan has that auto enrollment feature enabled. So we automatically draft our documents, whether it's a new plan or an upgraded, restated plan, to include that auto enrollment feature, to include the notices that are needed to make the self-employed business eligible to claim the credits. Now, part of that auto enrollment feature will establish a default 3% contribution percentage. But the solo 401k owner, the solopreneur, as the participant in the 401k, has the right to opt out of the default. And just because the solopreneur, as a participant, exercises their right to opt out of the default, doesn't mean that the self-employed business doesn't have a plan that includes the feature. They're just exercising their rights under that feature. So that means that the self-employed business is still eligible to claim those credits. So opting out of the default 3% contribution percentage simply means that now the person could contribute more, could contribute less, even zero. Obviously subject to the limits and the deadlines. In other words, they can contribute as much as they want, whenever they want, again, subject to the limits and the deadlines, and not being tied to some default contribution percentage. Now that feature will enable the self-employed business to claim $500 per year of tax credits for 3 consecutive years, as long as they maintain that plan. So those are tax credits, not tax deductions. So that means that it's a dollar for dollar reduction in their tax liability. So as long as the plan is established or upgraded by December 31st, now they're going to be able to start claiming those credits when they file their 2025 tax return. And those tax credits are going to more than cover our fees for the first 7 years, because we charge $650 as an initial cost. That includes the $525 establishment fee plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So if you add up those $1,500 in tax credits, that'll more than cover our fees for the first 7 years. So the impact is tremendous. Next question is from Rebecca. Is the voluntary after-tax contribution counted as part of the $70,000 max, or can be higher? It is counted. So that $70,000 overall contribution limit applies to all the contributions that were made to the solo 401k. whether employee, employer, or voluntary after tax. All right, again, if this is helping you to feel more confident about your retirement future, please like this video. It helps us to get the word out to other solopreneurs just like you. So we'd greatly appreciate that if you please like, whether you're on LinkedIn or X or Instagram or YouTube. We also want to invite you to our community. We have the largest community of solopreneurs, advisors around this solo 401k topic. We've got over 30,000 members, which means that we have a vibrant community, vibrant forums. We have a library of videos and webinars. So there's a ton of ways to learn and to share the knowledge. It's totally free to join. Just takes a minute. All are welcome. You don't need to be a client. You don't need to be an advisor. You can just be someone that's interested in the topic. So please don't hesitate to join. You can join quickly and easily at my solo401k.net/my community. All right, we'll give it a moment to see if any more questions come across. All right, looks like that's it for today's session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building the Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement. All right, thank you so much, everyone.